My name is Ismael Reyes, and thank you to our presentation, to come and attending this presentation with us. I'm the managing principal of Stressless Capital Fund, which is what we're talking about today. And I'm very excited about that. Both my partners and I, we're going to tell you about this innovative product. And I call it product because I believe that's the way we should look at this thing. The Stressless Capital Fund is a customizable real estate fund, which means that it's designed to meet the individual needs of each investor. Investors have their own risk profile. Investors have their own likes and dislikes. And this allows us to essentially customize the fund to help those investors be able to pick and choose the right type of investments within the fund itself. So really excited about that. And in this presentation, we'll tell you more about how that works, the benefits for investors in very much more detail, and how you can learn more. You're also going to have a chance to ask questions at the end of this presentation. I think that's probably the best, so we can get through it all in one piece here and then really just jump in and answer those questions, because I suspect we'll get more people as we get going here. We've got quite a few, but we'll get more, I'm sure, and this will allow them to kind of be there for that particular key piece. So if we can go to the next slide. So before we dive in, I want to talk a little bit about what this is, what you're seeing here. It isn't to sell you anything at this point. It's really just to present to you all and educate what the Stressless Capital Fund is. I think what we can say is it is a 506c investment opportunity for accredited investors. And furthermore, this presentation is not going to actually sell you anything. It's really just providing you information and giving you the opportunity to then sign up to get additional information. And that's all we want. We want to be able to get this out to everyone, because we believe it is a new model for investing in real estate. And we're going to talk about why that's really exciting. So why partner with us, right? For those that decide to, reach out, at least have a discussion. So if you consider learning more, one of the reasons why is those investors that understand the value of real estate, but don't want the hassle with the tenants or the toilets. And you'll see that what we're really doing here is passively investing. And there are other ways to passively invest. This just kind of gives you a better, again, a customizable way of doing that. Two, if you want the flexibility, transparency, and peace of mind, this is where you want to go, because it combines the best qualities of traditional funds with syndications while eliminating some of the negatives of each. Three, if you're overexposed to the stock market and you want to diversify into a less volatile investment, surely, as we've seen, all it takes is a tweet or one thing happening in the news before the stock market just goes nuts. This with real estate is different. It does go up and down, but it's a lot more rational in the way it does so. And four, if you're rushing to save for retirement and want lower risk investments that will support your lifestyle, this is definitely for you. Now, before we get started with the meat of the presentation, I want to take a moment to thank you guys for joining us today, and see we're getting more people coming in. We know that you have choices when it comes to investing, and we appreciate you taking the time to learn more about Stressless Capital Fund and about us. We'll go to the next slide. So, as I mentioned earlier, I'm the managing principal of Stressless Capital Fund, but I'd also like to introduce, and you've been talking to Kelly Iannone, who's our Director of Investor Relations, and has really put this together. And of course, Alfredo Hooker, our Director of Acquisitions, who's the one that really evaluates any deals that you all see, those that really take the next step. He's looking at all of those in conjunction with all of us, really taking the initial look to make sure that those investments meet the criteria that we want for ourselves and for our partners. Next slide. Just a little bit more about our team. We have a very strong track record. In fact, we've actually have about over 30 years of real estate experience between the three of us. Kelly's got a corporate background. Alfredo's got a supply and logistics background. I have a military background and have been doing this for well over 10 years, about 5 years actively since I retired, and well before that, while I was still in the military, going in and investing in property. So We really are really excited about that. We partnered on 16 total acquisitions at this point, valued at about $161 million. And 6 of those acquisitions, or about 300 units, have already gone full cycle, meaning we've brought it to investors, and we've returned investor capital plus their return on their investment. Next slide. So let's talk about why we started diversifying out of the stock market and why you should consider doing so as well if you haven't already started. Next slide. First, real estate prices are typically less volatile than stock prices. This means that real estate investors are less likely to experience large swings in the value of their investments. 2, real estate historically has appreciated over time, meaning that real estate investors have the potential to make money through capital appreciation. 3, real estate can be a good hedge against inflation because the value of real estate tends to rise along with inflation. This can help real estate investors protect their purchasing power. 4, real estate investors can generate cash flow from their investment by renting out their properties, or in this case, by these investments that operators operate that do provide a distribution to passive investors, which is what really we're doing as part of this fund, is bringing in passive investors. So operators rent the property, the money flows into the fund and back out to investors. And 5, real estate investors can take advantage of a number of tax benefits, such as depreciation and the ability to deduct certain expenses. These tax benefits can help real estate investors reduce their overall tax liability. And let's keep in mind, those that are in the stock market, they don't have that available to them. So when we start looking at returns, that's one thing that it's hard to measure between the two is with real estate, even as a passive investor in these type of deals, you're actually able to write off a portion of your income as losses. And we won't go into a ton of detail other than just like real estate, single family, you're able to depreciate a portion of that asset over time. We accelerate that even further in these type of investments, so that really in the first year, if you invest, let's just say 50,000, you're able to write off a loss of that, about half of that. So about a $25,000 loss as a passive investor. And it's just a paper loss, but it really does help offset any W-2 income or other income that you may have. But let's talk a little bit more about the return on investment, because unlike, and I mentioned this, unlike the stock market, which is pretty standardized, is very standardized actually, and it's been studied in a lot of detail, retail is difficult to categorize and standardize because it's of the unique nature of every single property and the privacy around most of these deals. These aren't things that you're bidding on an open market. You're actually there's a lot of closed door transactions that are taking place. But what we can use is something that allows us to essentially be a proxy for that. And that's using the FTSE NAREIT Composite Index. And that is a free float adjusted market capitalization weighted index of U.S. equity REITs. And so by using that as a proxy, we can get a good measure of that, that question, real estate versus stock. And what we've seen, and has been documented, there is a positive correlation between REITs in general and the overall real estate market, which is why it allows us to do this comparison. And as you can see in this chart, it dates back to 1971, and it's taken from realestateinvestment.org. Real estate, as tracked by this index, clearly outperforms the S&P 500. And you can see, as you look at some of the dips in the green line, that they correlate to some extent to recessionary periods. What we're not telling you is that there's no negative impact to recessions to real estate. What we're saying is it's less of an impact. The other thing is you can see it significantly jumps forward a lot sooner than the recoveries in the S&P 500. So there are two key things. Just to kind of put that into perspective, a $100 investment in 1972 would be worth about $6,839 in September of 2020, which is when this this is produced, this document. And this is a 68x your original investment and around a 9.425% return. Significant. So I'm going to stop talking right there and turn it over to my partner, Alfredo, who's going to discuss why we prefer to invest in multifamily real estate in this economic environment. Alfredo.
Thank you, Ray. So let's talk about apartments versus other real estate assets and why multifamily is more recession resistant than other real estate assets. Next slide, please. So in a recession, real estate assets have different levels of sensitivities to potential recessions and economic changes. For instance, if we are in a recession, people tighten up their budget, they don't travel as often. Retail stores may also shift to more online because they can't afford rent. We all went through the pandemic a couple of years ago, and we witnessed this landscape change in front of us. Even Zoom, right? Here we are in Zoom. We were doing some online in our business, but we were not running our business on Zoom pre-pandemic. Now, we don't even need in-person meetings. There's still some value in some of them, but we can't really do so much from a virtual perspective. Whereas apartments are valued differently, and everybody needs a place to live, so they are not as sensitive to the inflationary environments or recessions. Next slide, please. Okay. In addition, it's different how apartments and commercial properties are valued. They're valued differently from single families, homes. So as we talk about the difference between single family and apartments, when you want to sell your home, you go to your broker and the broker look and see what does your neighbor sold their house for. And you don't really have any control over that, right? So whereas apartments, there is a lot of more control because there is a measure that we can turn that's called net operating income. As we increase income and we decrease expenses, increases the value of the property. Also, banks and lenders have favorable terms, and they think favorably on apartments because they are income generating, which makes getting lending on them so much more attractive and, quite frankly, simpler to get lending on these larger apartment complexes. So let's talk about the value multiplier. So if we increase the income and decrease expenses, we get a higher net of operating income. In this slide that you're looking at, we're sharing a high-level example so that we can get an understanding of the force appreciation concept. In this example here, we increase rents on a 100-unit apartment complex by $100 a month. By doing this, we added $120,000 a year. You may be thinking that the property value will go $100,000 a year, but no. The reality is that because the way apartments, multifamily properties are valued, there is a major multiplier that is in play here. Whereas when we add $120,000 of income to the property, we force the appreciation and the value of the property up millions of dollars. So in this case, it's 2.4 million worth of value that we added to the asset by simply increasing rents by $100 a month on a 100-unit apartment complex. And this is based on a 5% cap rate. So you may be asking, what is a cap rate? Or cap rate is, or better called capitalization rate, is simply terms. It is the return that you will expect to get on your investment if you did not get a mortgage. So this is very powerful. And this is an eye-opener for new investors when they shift from the single family to the multifamily space. The main takeaway is that we're able to leverage this value multiplier to have a lot more control over our assets and our real estate portfolio compared to single family properties and other real estate assets as well. So for those reasons, we prefer apartments, multifamily, the current investment real estate cycle that we are in. So, and now I'll pass it along to Kelly. Kelly will go over how Stressless Capital Customizable Fund works. Kelly?
Thanks, Alfredo. Yeah, I was super shocked when I first learned about that value multiplier when I was just investing in single family homes. So I love that we kind of talk about what that is and just how powerful that is in the assets that we're doing. So I'm going to take us a little bit deeper and talk more specifically about a customizable fund and why kind of the benefits of it and what it looks like for the Stressless Capital Fund to be able to passively invest in it. Super high level from a how it works perspective. So a customizable fund, as Ray had kind of mentioned earlier, is that we'll pool these investments, or we'll pool the capital together and invest in these larger deals. Now, it's often one of the most common questions that I get when I start talking about this is people will ask, well, do I know what I'm investing in? And the answer is yes. It is not a blind fund like a lot of traditional funds are. And you're not going to be restricted to just investing in one asset. You're going to have the opportunity to invest in multiple assets. So you will by nature be able to customize your investments within your fund portfolio through the Stressless Capital Fund. We have some similar terms as you may have seen if you've invested in other syndications. Limited partner, these are the passive investors. This is you, right? This is the passive investors where you can continue to stay focused on what is most important to you and your highest and best use of your time, while you're able to grow wealth through real estate without having to deal with any of the headaches, including tenants, toilets, and termites. So that's really the benefit there. Then the K1 tax document, we'll talk about that in one of these other slides when I hit in more detail of one of the things that we really love about the customizable fund setup. And then the fund managers, that's us. That's myself, that's Ray, that's Alfredo. We're the fund managers for the Stressless Capital Fund. And really, we do all the day-to-day hard work. We're the active real estate investors here. We're sourcing these deals. We're underwriting the deals. We're working through our plan to acquire the deal and then subsequently oversee the asset management of the deals once we have them in our portfolio. So let's look a little bit more about customizable funds versus I talked about the traditional funds or the syndications. Really, with a customizable fund, we get the best of both worlds. We get the efficiency that you may see in a traditional fund, but the transparency that you get from investing in a specific deal through, say, a syndication. Some of the efficiencies that we have in customizable funds, and specifically that we are offering with the Stressless Capital Fund, is that we have one set of legal documents called the PPM, the Private Placement Memorandum. And that set of documents covers the entire fund as a whole. Now, there will be specific terms for each individual deal when you make the choice of what specific deals to invest in, but that big legal packet that you typically have when you invest in a deal, there's one of those for the fund. There's also the requirement for really one third-party accreditation letter, which you can then self-verify to extend for up to 5 years based on current U.S. Securities and Exchange Commission regulations. Because you are investing in the same fund, you are given that flexibility based on current SEC regulations. Another benefit to investors by investing in a customizable fund or through a customizable fund is once your distributions start for a particular deal that you're invested in, similar to a brokerage account, your distributions will be made within your investor portal. So those funds will be ready for reinvestment, so you can continue to grow your invested principal and take distributions from your investor portal at any time as well. And then I mentioned on the prior screen, taxes. We all just love taxes, right? Gathering all the statements every year. So with a customizable fund, there is one K1 tax document. So if you own potentially single family rental properties and you hold them in different LLCs, or if you've previously invested in any of ours or other people's syndication deals, you're going to get a K1 tax document for every deal that you're invested in. So come tax time, you could be chasing 5 to 10 K1 tax documents to get to your CPA. Through a fund like this in this format, you will receive one K1 tax document at tax season that will cover all of your investments within the fund. So this is, to me, this is like a huge benefit because it provides you with just ease, and it will cover them all within there, and your CPA will thank you. You'll probably even save money on your tax prep. So something definitely to kind of keep in mind there and not discount. And as you can probably tell, Ray Alfredo and I, we all love this solution, and we've done 2 deals within the fund so far, and our investors have really given some good feedback on it as well. So we're excited to continue to bring it to our full investor community. And let's dive in a little bit deeper about specifics on the Stressless Capital Fund. So for target returns and minimums, what we're typically looking at is a total hold period of 5 to 7 years for our equity investments. We're seeing some opportunity for some debt projects that we may consider as something to introduce through the fund that would have a shorter hold period. But at this point, we currently have been working with the equity projects. And again, that's typically a 5 to 7 year hold period. Target return. So when we talk target returns, we're always talking net of fees. This is what you, the passive investor, should expect to receive based on what our pro forma and assumptions are. These would be your projected return. So we're typically looking at projects that are going to provide a 6 to 8% cash on cash return in the form of distributions, typically quarterly distributions, a preferred return of 8 to 10%. And what a preferred return is it's not a guaranteed return. This is an investment. All investments have risk, but a preferred return really protects the passive investor in the way that you as a passive investor will receive 100% of the profits up to that 8 or 10%, whatever that preferred return is, prior to myself and the fellow fund managers, or even the general partners on the deal, receiving a share of the profits. So it's a way to kind of protect you as a passive investor. Now, in these deals, as Alfredo spoke earlier about the value multiplier, and as we increase the net operating income and then add the value to the property, we realize that value typically when we sell. That's when the bulk of the value is actually realized. And so when we look at the profits of a project over the total hold period, we're looking for projects that we're going to get somewhere between an 18 and 20% average annualized return, which said in a different way is close to having a 2x equity multiple, so doubling investor capital every 5 to 7 years. In regards to minimum investment, so the minimum investment for the fund is $50,000, and this is where the flexibility and being able to really diversify within the fund comes into play. Unlike investing individually in syndications where each deal typically has a $50,000, $75,000, $100,000 minimum investment, within the fund minimum is $50,000, and then you have an opportunity to invest a minimum of $10,000 in any future deal. So it really gives you a lot of opportunity to diversify. On the fee side, so our fund management fee is typically between 0 and 2%, and this is based on really us, the fund managers, our discretion, but it is disclosed prior to you making an investment in the deal details, the specific deal details. And where that range comes into play is that some deals, we are not only on the fund side, but we, the fund managers, are also general partners in the deal. Ideally, we're general partners in the deal because it gives us an opportunity to really be closer to the table and be in kind of sync with the general partners. And so when we do that, because we're not in this to double dip and get extra fees per se, we typically have a much lower fund management fee. For example, a couple of deals that we just finished in the fund, we only have a 0.25% fund management fee because we are receiving fees on the general partner side. And again, this is all disclosed in the deal details for specific deals as well. Carried interest, very similarly, the range is somewhere between 50 and 20% of gains typical. But again, if we're on the general partnership side, which ideally we are and we have for the last couple of deals, that carried interest would be much lower because again, we're receiving a share of profits on the general partnership side. And as far as deal investment minimum, so with the customizable fund, when we pull together investor capital, we're able to negotiate, use the power, basically the buying power of all of our investors' capital together to negotiate higher preferred returns and higher split of profit. And what that typically looks like is in a deal, we're going to invest a minimum of $500,000 in a specific deal, but typically we're looking at more like $1 million to $2 million, depending on where our funds are sitting. And then I mentioned distributions are quarterly basis. Now let's dive into the due diligence process, because this is super important as an investor to really understand how your investments being protected and making sure that you're investing in good deals and having that really trust within our team. So in the due diligence process, sorry, everybody loves the numbers, right? This is the process that really has evolved over time for our team, and it continues to evolve based on our experience in the deals that we're doing and learning on what to look out for, and also working with other seasoned investors. We always start with people because you can have a fantastic deal, but if you don't have the right partners or the right people in the deal deal just may not make sense. So we always start with people and understanding kind of their background, their track record, and then we also have kind of a checklist of red flags that we take our deals through and our sponsors through to really understand. And some of those questions are, how responsive are they to investor? Investor communications is extremely important. How responsive are they? Does the sponsor have a track record of prior deals? Do they have a present in the current market that we're looking at a deal in? And then also really stress testing their projections and making sure that they have reasonable compensation from a manager perspective as well. Next, we'll look at the market. Does the market make sense from a supply and demand perspective? What is the submarket demographics? We'll talk a bit about this more in a sample that we pulled together to kind of talk people through, but we're going to be really looking at, does it make sense for this market to continue to grow, or is this a market that is not going to be growing over time and may not make sense for us to invest in? Then we'll look at the deal specifically. For the deal, anybody can say they have a great deal, but when we start to look into the details and look into the assumptions, it can really be all over the place. So we are going to do underwriting from the ground up. Alfredo on our team is our lead underwriter. Ray and I will come in behind after Alfredo's kind of gone through everything, and we'll poke holes, we'll ask questions, we'll really challenge it and make sure it makes sense. Part of our role is to weed deals out, because we don't want to do a bad deal. We only want to do a good deal and when it makes sense. So we're going to go through and do the underwriting from a ground up, as well as look at assumptions from from an independent standpoint and see if we get to the same returns or very similar returns. We're looking for those risk-adjusted returns. We want more returns, we want less risk. Another step in our process is the actual property. When we're looking at one of these properties, we want to visit the property before we actually acquire it. So this gives us an opportunity to have better due diligence, to be able to actually see with our own set of eyes what the property looks like, talk to the current property management, and then talk to the operators as well. It also allows us to build a relationship with the general partners, even more so than we already have, with the end goal of being able to negotiate a better position for our investors and for the fund. So this means really comes into play by having higher preferred returns or a more preferred profit split. We want sponsors that want to work with us, that see us as preferred equity partners who are not only bringing capital, but that we're also bringing our expertise to navigate any potential curveballs that will come up. So that's a quick run through of our due diligence process for deals that we make available through the Stressless Capital Fund. Now I'm going to give you a real life example. So a recent deal that we did, it's Park Valley Apartments. It's located in the Atlanta, Georgia market, 236 units. This particular property, we had a lead sponsor who had a successful track record of going full cycle on over 1,000 units, and we had a pre-existing relationship with the lead sponsor. The market itself, it was in Atlanta. Atlanta's a great growing market. It has consistently been in the top 5 of markets in the nation for positive net migration. It's also the ninth largest largest GDP in the nation. So that's been really favorable. And again, with that growth trends, and it also has those the population and job growth trends. So we like seeing that it's got a very diverse economic engine there. The deal itself, we reviewed all the assumptions. It was a lower risk deal because we were able to acquire the asset with a 3.5% fixed interest rate. So it lowered the risk by removing the variable interest rate in this system, or this period of increasing interest rates. So we've got 9 years left on that loan at a 3.5% interest rate. Interest rates aren't a concern for this particular property. We stress tested, and it was able to sustain higher vacancy levels. One of the things we're seeing in the Atlanta market is that if we do evictions, it has taken longer to get through the eviction process. So when we're doing underwriting, we want to make sure we have higher economic vacancy rates and that the property can sustain it. The property itself. In this particular property, Ray visited the property prior to closing. So he had an opportunity to walk the property, meet with the lead sponsors, meet with the on-site property management team, and really validate the assumptions and validate what our understanding of the property was. And ultimately, we were able to negotiate an investment from the Stressless Capital Fund with a 10% preferred return to our investors and a more preferred equity split. So that is the ultimate goal as we walk through that due diligence process. And you may be wondering, I talked earlier about what our ideal returns look like in the fund itself. Again, this is just very specific with this case study for this sample one. This is Park Valley in Atlanta. This particular project, we're looking at a 20% annualized average return over the life of the hold period. So with an investment of $100,000, you get roughly $50,000 over the 5-year hold period in the form of distributions. And then the remaining about $50,000 comes from the proceeds of the sale. And then with your return of capital, it's a 2x equity multiple. So doubling your money in that 5-year hold period in this particular example. And again, this is just an example to kind of see what the numbers look like. And then to Ray's point earlier about the tax benefits, you'll see there's kind of a note here, basically half the investment will come back in the form of depreciation benefit in that K-1 tax document. So that's really quick kind of going through through an example and kind of what we look at from a due diligence process, and then the customizable fund. How to get involved. If this is the right fit for your family's goals, let's have a conversation. Investing in real estate's great. I think everybody needs to be looking at it and seeing how they can diversify their investments. But it needs to make sense for your family's financial goals. So if you want to stay connected and get in touch, there's really 3 different ways that I recommend people do, depending on kind of where you are in your journey and you're assessing the fit. First is the preferred investor list. So we maintain a preferred investor list. If you're somebody who knows this is a right fit for you, you want to get involved, you're looking at moving capital in the next 3 to 6 months, let us know that. Shoot us a message directly. We want to definitely have a conversation. We're highly regulated by the Security and Exchange Commission, so we definitely want to know who you are. And then the preferred investor list, basically, when we get a deal that we're getting ready to build in the platform, you'll be one of the first to know. We'll pick up the phone, we'll give you a call, and we'll give you a heads up that's coming. And one of the other ways to get a hold of us is to grab coffee. We can grab coffee over Zoom. So this QR code, if you want to grab coffee, scan the QR code. This will go to my calendar. We can have a quick 15-minute intro call. Make sure, we'll chat about what your family's financial goals are, what your investing experience is. Make sure that it makes sense for us to continue to have the conversations, and then we can have additional conversations from there for fit. In the middle here, I totally skipped it, but I'm often asked what our next opportunity is. We're actively searching and underwriting. As I'm sure you can imagine, in the current market, we are being ultra conservative and making sure that we are really finding the best deals. So we're continuously looking at potential opportunities. Make sure that you let us know if this is something that you want to move forward on, especially if you want to be on a preferred investor list, and then we can kind of take it from there.